When we think about the creation of a pro forma income statement, it's really dependent on how long do we want to hold the asset, right? So when you think about the hold period, it's really dependent on the strategy at the asset. And when I say strategy is, what is the business plan? What is the manner that you as the owner of the building are going to execute your ownership? So as an example, let's say I'm buying an apartment building in Washington, D.C. that was built in 2018, is fully leased. I'm likely to hold that building for 10 years because that strategy is it's a brand new building that's fully leased. I'm likely to buy that building for the purpose of cash flow. And so consequently, I will intend to hold that building for at least 10 years, probably 7 to 10 years. So when we're creating our pro forma income statement in that scenario, we're creating a pro forma that has 7 to 10 years worth of cash flows so we can understand what the value of the building is over our hold period. Now, let's take an example of an apartment asset that was built in 1960. And let's just say it's the owner of the building has underinvested in the asset, right? There's deferred maintenance, and all that simply means is they haven't maintained the physical nature of the building. It needs painted, it needs new asphalt in the parking lot, whatever it might be. It's in disrepair. A strategy might be, I'm going to buy that asset, I'm going to invest money into the asset immediately to cure the problems, to fix the problems. I'm going to lease the space up again at hopefully higher rents, and I'm going to sell it. So in that scenario, that's called more of a value add strategy. The hold period is very short. And in those scenarios, you might be owning the asset for 3 years, 4 years, as opposed to the 2018 built asset, 100% leased in Washington, D.C., where there's no work to be done to the physical real estate, and we'll probably own that for 7 to 10 years. So the strategy that the owner endeavors to execute at the building will really drive how long you would be looking at cash flows. When we think about a pro forma income statement, there are two components to the pro forma income statement. The first component is the operating cash flows. Think about operating cash flows as really nothing more than the rent you receive from the tenants on a monthly basis. So every month you pay, or somebody pays, the tenants pay you your rent, right? And so when we think about operating cash flow, that's the monthly rental cash flow that we receive by ownership of the real estate. So that's the first part. So the second part, though, is the reversionary cash flow. And the reversionary cash flow is what is the money we receive when we sell the real estate. And when we think about the valuation process of a real estate asset, not only are you having to project the cash flows, the operating cash flows associated with receiving rent, paying operating expenses, getting the property before tax cash flow, we also have to figure out, well, what do we think we're going to be able to sell the real estate for? And oftentimes that residual value, as we call it, is a significant component of the total investment performance because it's such a large amount of money. So when we create this pro forma income statement and when we walk through the valuation thereof, you're creating the operating cash flows as well as the residual cash flows. Our ability to sell the real estate asset at the end of our hold period is really dependent upon and a function of what is the cash flow that our buyer is going to receive when they buy the real estate from us. So if we think back to what we had discussed about the pro forma income statement, which is revenue minus operating expenses equals the net operating income, the residual value, what we sell the real estate for, is really dependent on what is the net operating income, the NOI, in the year after we anticipate selling the asset. So let's think about an example where we're intending to hold the real estate for 10 years. So we are projecting 10 years worth of cash flows plus an 11th year. So we project 11 years of total cash flows, but we only plan to hold the building for 10 years. The reason we project that 11th year of cash flow is that 11th year of the net operating income is what we will use to determine what we sell the real estate for. So if we were to have a net operating income in that 11th year of X thousands of dollars, we would apply what we call the exit cap rate, which is simply the cap rate with which we will sell the real estate for. So the exit cap rate is the year 11 NOI divided by what we anticipate selling the real estate for. We can determine what we're going to sell the real estate for by taking that 11th year of NOI and dividing it by the exit cap rate to get to our residual value. So if we think about how do we determine what we sell the real estate for at the end of our hold, we have to look to 1 year past our hold period, so the 11th year of cash flows. We look to the net operating income of that year of cash flows. We divide it by the exit cap rate to then get to the residual value of our asset. So that residual value coupled with our operating cash flows is what we will then discount back to the present value to determine what we pay for the real estate. When we think about what we sell the real estate for at the end of our hold period, it's not just what somebody's going to show up and pay us for, because it could be a scenario, a situation where we take an asset to market to sell and the bids aren't attractive. All that simply means is what the buyer community is interested in paying is inconsistent with what we think the real estate is worth. That is known as a bid-ask spread. So you have the ask, which is what you want to earn in your sale price, and you have the bid, which is what the buyers are offering. And if the bid is different from the sale or the ask, you have a bid-ask spread, which means there is likely no transaction. So the residual value is heavily dependent, though, on what the capital markets are going to offer at that point in time. And when I say the capital markets is, what do the buying community, or what does the buying community believe the value of the real estate is? So remember, if we're thinking about a 10-year hold period, we are projecting what we think the residual value of the asset is going to be 10 years from now, which is extremely hard. That goes back to this idea that regardless of what you project in your cash flows, they will be wrong because you're asking to project things 10 years into the future. So when we think about the residual value, the manner with which you calculate that residual value is in part dependent on what are similar assets trading for today. So let's talk about the mechanics of the pro forma income statement, but generally as it pertains most importantly to the residual value. So let's just assume for the purposes of this example that we're buying an apartment asset in Washington, D.C., and we expect to hold the building for 5 years. So the first step that we have to go through is we have to project our cash flows. So revenue minus operating expenses equals NOI minus capital expenditures equals property before tax cash flow. So we have to make assumptions for each and every year for our hold period. Our pro forma statement needs to extend 1 year beyond our hold period. So in the example I just gave, if we are going to endeavor to own an apartment asset for 5 years in Washington, D.C., we need to project 6 years worth of cash flows. And the reason we project that additional year of cash flow is that 6th year of cash flow is what's going to be utilized to calculate what we will sell the real estate for at the end of the 5th year. So if we think about buying something on January the 1st and holding it through the 60th month, which would be December 31st of the 5th year, we will sell the building on December 31st of the 5th year. The price that we endeavor, expect, anticipate, believe, underwrite, we will earn 5 years from now is through taking the net operating income of that 6th year and dividing it by something known as the exit cap rate. The exit cap rate is simply an income yield. It's a return metric. It's a yield metric that is used to convert cash flow into value. The reason we use the 6th year of NOI as opposed to the 5th year of NOI is that 6th year of NOI is going to be our buyer's first year of cash flow. So if you put yourself in your buyer's seat, they are going to start with, well, what's my first year of cash flow? And upon that, that will drive what I pay for the real estate. Well, if you think about what we're doing in our pro forma income statement evaluation process, 5-year hold, but we have to project 6 years worth of cash flow because our buyer is going to use that 6th year, our 6th year, which is their year 1, upon which to determine what the exit value is to us, which is the purchase price to them.